Welcome to yet another video on the capital asset pricing model. In our previous presentation, we analysed a small market of just 3 stocks. The reason we created a small market was because we wanted to illustrate that if you have a beta estimate for every stock in the entire market, the market value weighted average of the beta estimates for all of those assets will be equal to 1. Having verified that, let's look at how we would actually estimate beta for an industry or a company with respect to a large market. How are we going to define a large market? Well, in this case, we're going to define a large market as the S&P 1500. The S&P 1500 is a market of 1500 large liquid companies listed in the United States, and it's a broader sample than the S&P 500. For completeness, the S&P 500 contains 500 large listed stocks. The S&P mid-cap 400 contains another 400 mid-sized stocks, and the S&P small-cap 600 contains the remaining 600 stocks. So the S&P 1500 index is broken up into 3 buckets. The S&P 500, which you're probably most familiar with, the S&P mid-cap 400, and the S&P small-cap 600. What we're going to do is estimate beta for a fast food company using 4 proxies for fast food companies. Those proxies are going to be McDonald's, Yum Brands that owns KFC, Taco Bell and Pizza Hut, Domino's, and Restaurant Brands International that owns Tim Hortons, Burger King and Popeyes. The reason we're going to use 4 companies is because there's estimation error in the beta estimate for any individual company. And the point is that even if you're estimating beta for McDonald's, you can't just use the McDonald's time series of stock returns to estimate beta for McDonald's, because in McDonald's own time series of data, there's a bunch of noise. Things happened in different months or weeks that shifted the Domino's stock price due to McDonald's stock price due to something specific related to McDonald's, and we want to mitigate the impact of that noise. So I would say McDonald's is a fast food company. I want to estimate the beta estimate for a fast food company. We're going to estimate beta using Friday to Friday and Wednesday to Wednesday returns using weekly returns information. And this is to demonstrate that your beta estimates bounce around substantially depending upon how you defined a week. So that means you're going to estimate in practice your beta estimates 5 times and average those beta estimates to mitigate estimation error. So let's repeat our 4 techniques for estimating beta. We're going to draw a scatter plot. We're going to perform regression analysis by going to the Data Analysis tab and selecting Regression. We're going to use our slope function, and we're going to use our functions covariance and variance. Now at different times I might pause the presentation just briefly because I have to toggle between 2 different PowerPoint presentations and 2 different Excel spreadsheets, and I might just pause for a moment to allow me to do that. I'm going to go to the worksheet, the before class version of this worksheet. I'm going to move to my analysis of fast food using Wednesday to... I'll use Friday to Friday returns first. Let's do that. So what I have here in this data sheet is weekly stock returns using different definitions of a week. You can see that the weekday is number 6. That's going to be Friday if we define a week starting on a Sunday. And I've already computed the percentage change in the stock price, but then also incorporating a dividend yield. So these are percentage total returns on each stock on a weekly basis. And I have here the market returns in column H. So columns C, D, E and F, they are going to be weekly stock returns for individual stocks. Column H is going to be market returns on a weekly basis. Let's compute our scatter plot first. So turning to our data tab, I'm first going to highlight the column C, which is going to be weekly stock returns on McDonald's. I'm going to highlight column H, which is weekly returns on the S&P 1500. That's our definition of the market. I'm going to go to Insert Charts. I'm going to select the Scatter Plot section. And if I click on the first icon there, I have a scatter plot. But I want to make sure I have my X and my Y variables correctly specified. The X variable, which is the independent variable, has to be the market returns. And when we click on the data, the X variable has to go first. At present, those variables are switched around. So I have to change column C to column H because I want the X variable on the horizontal axis. And I'm going to change H to C. So I have my scatter plot. To find beta, I'm going to right click on the data and I'm going to add trend line, and I'm going to specify some options for the trend line. I don't want to constrain the intercept, so I'm going to leave the intercept dialog box unchecked. I'm going to click display the equation on the chart and display the R squared figure on the chart. And so this says that the weekly stock returns on McDonald's equals 0.6 plus 0.0016, and the R squared is 0.2084. And that tells me that 21% of the variation in McDonald's stock returns on a week-to-week basis can be explained by variation in market returns on a week-to-week basis. That means that the remaining 79% of the fluctuation in stock returns for McDonald's on a week-to-week basis must be explained by something other than movements in the S&P 1500 index, something to do with the fast food industry in general, or something to do with McDonald's specifically. So I'm just going to check I have the right beta estimate by referring to my after-class version of the presentation. That is going to be the beta estimate. It's going to be 0.6. But let's see how we can find that estimate in other ways. The second way we can find the beta estimate is by going to the Data Analysis tab and selecting Regression. So if I go to Data and click on Data Analysis and click on Regression and select the Y range, I will select cells C2 to C1265. And then if I select the X range for the independent variables, again I'm going to select cells 2 to 1265 in column H. I don't have to change anything else. I could output some other data, but I don't need to. I'm going to hit OK. And that's going to create a new tab. And the key item we're looking for is the coefficient on the X variable. And that is 0.6. That's the same as the slope from our regression analysis, so we verified that. And the R squared is 0.2084. So we verified the slope. We can also verify the intercept at 0.0016. And we can verify the R squared at 0.2084. Thirdly, because we might have to do this many times, let's use our slope equation. To find the beta using the slope function, we can write equals SLOPE, open parentheses, highlight the dependent variable, cells C2 to C1265, put in a comma, then highlight the independent variable, the market returns, that's cells H2 to H1265, close parentheses, and you should see that that is 0.6. Now I'm going to lock in those cells by putting dollar signs in front of the row and the column. I'm going to drag it to the right and I'm going to verify the R squared. Our function for R squared is just equals RSQ. That's 0.2084. And if I wanted the intercept from the regression, I could type equals intercept, and I've got 0.0016, same as we had for our two prior analyses. Finally, I can use our covariance and our variance equations. So our covariance function is equals covariance dot S for sample. That's 0.000333. And then I could have variance of the market returns, and I'm just going to refer to column H. And if I take the ratio of the covariance of McDonald's weekly returns with market returns divided by the variance of market returns, I have a slope of 0.5965. So using 4 techniques, we have estimated beta for McDonald's using weekly stock returns and Friday to Friday as the definition of a week. Now in the presentation, returning to my after-class version of the PowerPoint here, I've done that same computation for McDonald's, Yum Brands, Domino's and Restaurant Brands International. But then I repeat the analysis using Wednesday to Wednesday returns as the definition of a week. And I strongly recommend that you repeat all these computations because it's important that you practice the computations. It's the only way that you will remember how to estimate beta in a practical sense. If we use Wednesday to Wednesday returns, we get different answers. The biggest gap in the beta estimates is for McDonald's of 1.12 versus 1.00, that gap of 0.12. Now that could be material. If, for example, you thought the market risk premium was about 6% and your beta estimate was differed by 0.1, depending upon whether you just prefer Friday to Friday returns or just prefer Wednesday to Wednesday returns, you are going to change your your cost of equity estimate in valuation by 0.6%. That is the 6% market risk premium times 0.1. And that could have a material impact on your valuation just by random chance. So why do that? Run the beta estimate 5 times using 5 different definitions of a week and take an average. Continuing on, a common question is, how many companies do we need for a reliable estimate of beta? Here we've used 4 for illustrative purposes, but what's the right number? There's no particularly good answer to that question, but let me give you a reference point. I recommend that 27 is okay, 9 is too small, and 18 is a good start. Now those aren't technical terms, but those numbers of 9, 18 and 27, they actually come from some research. So some colleagues and I, as part of work which was relied upon by large companies in trying to estimate a fair rate of return, we estimated how much our beta estimates would vary across an industry if we randomly selected groups of 9, 18 or 27 companies and called those comparable firms. So we took a data provider's definition of an industry, and we repeated this for many different industries and said, suppose we run beta estimates using the standard regression technique that data providers use when they report beta estimates for their clients. Regressing stock returns and market returns, just like we've done 5 minutes ago. We came up with a beta estimate for each company, and we took an average of 9 companies, and then we randomly selected 18 companies, and then we randomly selected 27 companies in the same industry, and we said, how much does the variation in beta estimates on average across many, many repeated samples shift as you increase the number of firms in your comparable firm set from 9 to 18 to 27? The dispersion of beta estimates falls by about a third as you go from 9 to 18 companies, and it falls by about 50% as you go from 9 to 27 companies. So the key point is that you cut down your estimation error by about half if you move from 9 to 27 companies. Now, you might not have 27 companies which are highly comparable, but you don't necessarily need them to be perfectly or very highly comparable for beta estimation. The key point is to minimise noise in the estimate. You don't want your discounted cash flow valuation bouncing around purely because of noise in the data. However, the analysis is different if you're doing a multiples valuation. When you're selecting firms for your multiples valuation, like using price earnings ratios or value to EBITDA ratios, value to EBIT or value to sales, like we've done in a previous class, it's more important on a relative basis to have firms which are highly comparable, because the beta estimate is only one part of your discounted cash flow valuation, but it can ruin it if it's a very noisy and unreliable estimate of beta. Whereas your multiples analysis selecting firms which look very, very close to the firm that you're trying to value is going to be more important, because multiples across firms that are not very comparable differ significantly. More importantly, the key unit of analysis going into a multiples-based valuation is the price of a share at any time. We take price divided by earnings defined in some way. We've got different definitions of a price. It can be enterprise value, or it could just be price per share. That's equity value per share. But when we're looking at beta estimation, and we took those weekly percentage returns, the key unit of analysis going into our regression is a change in price. Changes in price are much noisier on a week-to-week basis than the level of price compared to earnings on a week-to-week basis. So put it this way, the impact of having a small number of comparable firms on noise in your beta estimate is large, whereas the impact of having a small number of firms on your multiples analysis is not so great. So to have the same degree of overall estimation error, you could have about 6 firms be a good start for multiples-based analysis, whereas about 18 firms be a good start for estimating beta. Furthermore, about 12 firms I would say is okay for multiples analysis, whereas I would say 27 firms is okay for beta estimation. You don't need the same comparable firms set to estimate beta as doing your multiples analysis. So suppose that my task was to estimate on a multiples-based valuation the value of a hamburger chain, which is primarily a franchise operation, and it is operating primarily in the United States. I would say, well, McDonald's is a comparable firm, Wendy's is a comparable firm. I could go to a bit more, expand that a bit further, and I might say, do they need to necessarily produce hamburgers? Could I include KFC? They're selling chicken instead of beef, but it's a similar business model. Maybe I'll include the owners of KFC, which is Yum Brands. Would I necessarily go to Restaurant Brands International though? That could be a different consideration. That had Burger King and Popeyes. Yes, that seems pretty similar. Would I expand though to Domino's? Maybe I would say Domino's isn't comparable because it's not a hamburger chain. If I was doing multiples, like this would be a really important consideration. But if I was estimating beta, I don't care. I just want lots of fast food companies, because the beta estimates, because of that random variation in the historical returns data, are very, very noisy. And they have the chance to make your valuation based upon those beta estimates highly unreliable. Okay, so next question we want to analyse is to compute the proportion of each stock's return that is comprised of systematic risk versus diversifiable risk in the following steps. We're going to estimate beta using Friday returns, which we've just done for each company. Then we're going to estimate the variance of weekly stock returns using our variance equation. We're going to estimate the variance of market returns using our variance function. And then we're going to compute the variance of market returns for the period when you have stock returns on that particular stock. It's got to be the same time period. And then we're going to use our equation for the systematic risk component of the stock's returns, which is going to be the beta squared times the variance of market returns divided by the variance of stock returns. All right, and then we're going to do a computation of the R squared. So let's have a look at that analysis. Turning to my data tab, here's what I'm going to do. I have the beta estimate for McDonald's. I'm going to compile many beta estimates. Okay, so what I'm going to do down the bottom of this tab, I'm going to use my slope function to compute the beta estimate for all of these companies. So I'm going to write slope. I'm going to highlight all the cells from C2 to C1265, put in a comma, and then highlight all of the market returns from H2 to H1265. I'm going to lock in the column H, and I'm going to lock in the rows, but I'm not going to lock in the columns for the individual companies. So that beta estimate for McDonald's we verified is still 0.6. I'm going to drag that all the way across. I'll come to this market-based estimate of beta a little later. So I've got 4 different beta estimates for the relative companies, the respective companies. 0.6, 0.78, 1.00 and 0.93. The risk component due to systematic risk is going to be beta squared times the variance of market returns. Alright, that's going to be how much systematic risk is going to be for the stock. And we're going to divide that by the variance of stock returns to get a proportion of total risk explained by systematic risk. So here's our equation. We are going to write VAR.S, that stands for variance of a sample, and I'm going to highlight rows C2 to C1265. I'm going to drag that across. So the last column is the variance of market returns. And to get the proportion of the total risk, which is explained by market returns, I'm going to take beta to the power of 2 multiplied by the variance of stock returns divided by the variance of market returns, and I'm going to drag that across. Quick correction, scrub that. I'm going to take beta squared times the variance of market returns divided by the variance of stock returns. So the variance of stock returns is in the denominator. And we're trying to say, well, what proportion of the week-to-week movement of the stock returns is explained by what's happening in the market. Right? So we're taking the total variance of the stock returns. In the numerator, we've got beta squared times the variance of market returns. That's telling us how much of that variance we're exposed to because of overall market movements. And that proportion is 0.2084 for McDonald's. Would you believe that that's identical to the R squared? Right, that's what we're trying to say. The R squared from the regression analysis is telling us the proportion of the stock returns which is explained by market returns. Well, that's exactly what's going on here with our equation. Beta squared times variance of market returns divided by the variance of stock returns. We can verify that those computations are the same that we would get if we applied our equation for R squared, and we have cells C2 to C1265 and H2 to H1265, and lock in column H. I did have a slightly incorrect cell reference for my equation. I did not correctly for Yum Brands and the market return correctly lock in the cells. So let's do that again. I'm going to take beta squared times the variance of market returns divided by the variance of stock returns. The reason for my slightly incorrect equation is that I forgot, even though I put it in my slide, I forgot to say only compute the variance of market returns for the period when you have stock returns for that particular stock. So if you look at my computations here, Yum Brands was not listed for the entire time period. So I have to remove those weeks of returns in my equation. So I'm only going to do for Yum Brands rows 143 and onwards. And if I make that correction, to both the variance of market return, stock returns for Yum Brands, and the variance of market returns, you'll see that the computations line up. On the after-class version of the spreadsheet, if you go to the Solution tab, Solution Fast Food Beta, all the computations appear. We have beta estimates using Friday to Friday returns using the slope function. We have beta estimates using Wednesday to Wednesday returns using the slope function. We've got variance of returns on the individual stocks. we've got variance of returns on the market, and you will see as I go across that the starting point for the variance of market returns changes in each column, because I only want to grab the market returns for the same time period where I have stock returns available. If I use our equation that says the systematic risk contribution to variance is beta squared times the variance of market returns divided by variance of stock returns, I have the proportions that you can see in column 12, in row 12. And if you look at R squared, you can see that we match up with those relative proportions. The final computation to do is to look at an industry. Let's suppose that you are examining a fast food company and your question is, well, what's the beta estimate for a whole industry, and what proportion of total returns in that industry is explained by systematic risk? So what I did was compute the weekly returns for the whole industry, and you can see that I'm using the average function for all of those stocks. So I computed the average stock return of all 4 companies in the industry, and I estimated beta for that industry. And in the Solutions tab, what you can see is that for the whole industry, the beta estimate using Friday to Friday returns is 0.8. The variance of industry returns is 0.00071, and that is less than the variance of any individual company. You can see that I've got the variance of McDonald's, Yum Brands, Domino's, Restaurant Brands International, and then the variance of the industry. So we're getting some diversification benefit here because we are stripping out some of the company-specific impacts on stock prices. If I go one step further and say, well, how much did systematic risk contribute to the variance of the industry returns, that number has jumped to 0.49. And that's up from figures of around about 0.2 for individual companies. So what that tells you is that roughly 49% of the week-to-week movement in the restaurant industry is attributable to what's happening in the market, whereas only about 20 to 25% of the variation of returns of an individual stock from week to week is due to industry returns. So if you look at the McDonald's share price, what you can say is that, well, about 50% of the share price movement is some association between industry returns in the fast food industry and what's happening in the market. The remaining 50% of the movement is something that's associated with McDonald's itself. Right? Maybe McDonald's has a new marketing campaign, maybe consumer preferences have changed and McDonald's can't easily adapt to those. Something to do with McDonald's. So that's a bit of a conclusion about estimating beta in a practical sense. The implications of all this analysis is that you have to use a large number of data points to estimate beta to minimize estimation error. You want to use a large number of comparable firms to estimate beta. You want to repeat your analysis 5 times using weekly returns and take an average. You can use less firms for multiples analysis than for estimating beta, because percentage changes in returns are a lot more noisy as a unit of analysis than looking at prices divided by earnings or value relative to EBITDA and so on. So for multiples analysis, 6 firms is a good start, 12 firms is okay. For beta estimates, 18 firms is a good start, 27 is okay. You don't necessarily need to have exactly the same firms in your beta estimation as you have for your valuation using earnings multiples. That concludes our discussion of beta estimation. In the next presentation, we're going to be talking about estimating other inputs into the capital asset pricing model, namely the risk-free rate and the market risk premium. We'll then go on to some limitations of that model. I look forward to that discussion.